Hi, everybody, and welcome back to video number 2 on our group project instructions. I'm giving you a big hint for your group project on this slide here. First, we'll learn how we do a weighted average cost of capital calculation. The key thing to know here is that debt is deductible as interest expense on the income statement. And as a result, there's a benefit associated with that. By reducing income, we reduce our taxes. So we have to make an adjustment to our pre-tax cost of capital for debt, where we do not have to do that for stock because we don't pay taxes on stock issuances. So the red numbers here represent what you would be given in the uh, problem. And the blue numbers are what you would calculate. So the capital percentage here is the percentage that 100,000 represents of 300,000, or 33%. And then stock represents the balance. It'll always equal 100%. Our pre-tax cost of capital for debt is 10% and stock 12%. So if I looked on the loan documents for that debt that we might borrow from a bank, it's going to say 10%. But our applicable tax rate is 30%. So, so we calculate the after-tax cost of debt by multiplying the 10% times 1 minus the tax rate. So 1 is 100% minus 30% is 70%. 70% of 10% is 7%. Okay. And then we take the 12% from stock and just bring it over because it's already after tax. And then we multiply the after-tax cost of capital percentages here by our capital percentages that we calculated here. So 7% times 33.33% is 2.33%, and 66% of 12 is 8%. We add the two of them together, we get 10.33%. And this is why I call it a butterfly chart. Back when I first started teaching, a butterfly indicated something that was really important. And you'll notice this is a monarch butterfly, so it was particularly important. And so let's look at the weighted average cost of capital for the project. And this is what you're going to be able to do. You'll just need to transfer these figures into the template that I've provided to calculate this 15%. You'll use the 15% as your discount rate for the entire project. But let's see how we calculate that. We start with 100,000 here, 200,000. We calculate our capital percentages the same way. But our pre-tax cost of capital is a little different. It's 13% for debt and 17.96% for stock. Okay, that's a pretty precise percentage. I needed to do that to make this 15% come out exactly 15%. Tax rate is 30%. So we're going to say we're going to multiply the 13% times 1 minus the tax rate. That's 100% less 30% equals 70%. 70% of 13% is 9.1%. And we bring the stock pre-tax cost of capital over into the after-tax cost of capital column. Then we simply multiply these after-tax cost of capital times these capital percentages, just like we did. We add them together and we get 15%. And that's what you need to do for the project. Big hint. Have fun. Okay, here we've moved to the demo net present value and internal rate of return file. This is a little bit redundant from the first Steve's Way file I showed you, but it gives you a little practice in calculating these compounding factors using undiscounted cash flows, calculating the present value by dividing by my factors, and also a cumulative column for payback and a cumulative column for break-even time. Now, some people are interested in how we calculate the numbers that are in the present value tables in the back of the book. And I show you here for this 10%. Here, all we're doing is we're taking my factor and dividing it into 1. And that will calculate those book factors. And you'll find these exact numbers in the first table of the present value tables. Now, one thing I want to point out, let's say instead of 10%, your discount rate was 9.25%. You can see that I easily can calculate the book factors. And of course, my factors as well calculate automatically. But you won't find 9.25% in the present value tables in the back of the book. That you won't find these numbers. So if you happen to have numbers that are not included in the present value tables, you wouldn't be able to use them. Anyway, I'll change this back to 10%, and those you will find. We calculated the internal rate of return the same way that we used in Steve's way. So I won't spend any more time on that, but I thought you would appreciate it. Here, don't forget, if there is a salvage value in your problem, be sure to add it here in the undiscounted cash flows. Here there was a $10,000 salvage value. So you can see I've added it here to the end of these salvage values. Okay. And that, I think, does it for this particular file. You can take a look at that, calculate your numbers accordingly using Steve's way. Okay, in this file, we're going to take a look at Profitability Index. I went through it quickly in the Steve's way template, but again, here's our same numbers, our same discount rates, our same factors, and you'll see this one's a little bit better illustrating that we have cash out here of $500,000, and then our discounted cash flow in the red numbers here. So I add all these red numbers together and I get 568,618, and our cash out was 500,000. And I divide the 568,000 by the 500,000, my profitability index comes out 1.14, and it is greater than 1. So in this case, it's going to be a go project. We would accept this project because we're adding stockholder value. And if I look at this arithmetic here, very easy. Okay, I think you get Profitability Index. Don't forget to do it in your group projects. In this file, this is a demonstration of the accounting rate of return. I admit that I don't use this very often in the real world because it has some serious weaknesses, which we'll discuss here in a second. But it is on the group project and it is part of the text, so I'm duty bound to teach it to you. And here's an example of how we would do that. The Wilson Company has an opportunity to invest in 2 projects. Project A requires a $350,000 investment for new machinery with a 4-year life and no salvage value. Project B requires $350,000 investment for new machinery with a 3-year life and a $10,000 salvage value. Now, if we were doing net present values, or for that matter, internal rate of return, we would adjust these cash flows or adjust these for cash flows, which would include an adjustment for depreciation. For accounting rate of return, we don't need to do that. We will focus on net income. So even though the company uses straight line depreciation and cash flows occur evenly throughout the year, for accounting rate of return, we don't care. So here is our income statements for Project A and Project B. We sold differing amounts here. This is not the investment now, this is the sales, and this is the sales for Project B. And it results in net income of $56,000 and $36,400. Now what we do then is we simply take the net income and divide it by the average investment. And the average investment is, for Project A, we take this 350,000 and simply divide it by 2. And then we divide 56,000, which is the net income, by that, looks like about $175,000. And that gives us a 32% accounting rate of return. A good rate of return, and as you can see. But it gets a little tricky here with salvage value. We would add the salvage value to that beginning investment of 350,000 for Project B, and then divide that by 2 to get the average investment, and then divide that into the net income here of 36,400. The weaknesses in my mind are significant. It ignores the time value of money. It focuses on net income, as you see, instead of cash flows. And here, you'll appreciate this a little more when you do your group project, but if the income and thus the accounting rate of return varies from year to year, which it does in the group project for one of them, the project might appear desirable in some years and not in others. You'll see that again illustrated in the group project. So I think that represents everything you need to know about accounting rate of return. And so that represents a nice place for us to stop this video. And when we return, we'll take a look at the remaining files for the project. Until then, bye for now.